This week, I will start my video with NVIDIA, as next week the much-anticipated quarterly earnings report will arrive, and it makes up a significant part of my portfolio. This will be one of the most important events not only for the company, but also for the entire technology sector, as NVIDIA's performance and guidance often set the tone for market sentiment. The results are receiving particular attention now, as demand for AI chips, Chinese market restrictions, and the ramp-up of the Blackwell architecture are simultaneously shaping the outlook. Let's go through why it might make sense to sell, and why it might make sense to hold NVIDIA stock in the portfolio. Why a stock price increase may be expected one. Analyst expectations are very strong, with the average price target close to $198, which is about 13% higher than the current price. 2. Several major investment banks have set even higher targets, for example, Wedbush at $210, KeyBank at $215, and Morgan Stanley at $206. 3. NVIDIA continues to dominate the AI chip market, which is driven by explosive demand from cloud service providers and artificial intelligence development. 4. The data center segment is growing extremely rapidly, showing 73% year-over-year growth in the previous quarter. 5. The ramp-up of the Blackwell architecture and large-scale AI investments by enterprises could further strengthen revenues in the coming quarters. 6. Recent comments by Fed Chair Jerome Powell signaling potential rate cuts are favorable for growth stocks, and NVIDIA could benefit from this market sentiment. 7. If the earnings report shows revenue and profit above analyst expectations, it could trigger another upward wave in the stock price. Why a stock price decline may be expected one. NVIDIA was forced to halt production of its H20 chips after China banned their use, which could cause about $8 billion in lost revenue. 2. Strict U.S. government export restrictions and ongoing geopolitical tensions with China add further uncertainty. 3. NVIDIA shares are trading at extremely high valuations with a forward P/E ratio around 40, meaning that investors expect very high growth. 4. Any slight shortfall in revenue or profit, or weaker than expected guidance, could immediately trigger a drop in the stock price. 5. Market rumors suggest that development of the next-generation Rubin chip may be delayed, and although the company denies this, the uncertainty could negatively affect the stock in the short term. 6. In recent weeks, investor interest in technology stocks has decreased, and if another wave of selling hits the sector, NVIDIA will not be able to escape the pressure. 7. Global macroeconomic risks, such as geopolitical tensions, inflation, and potential U.S. political interventions, also pose downside risks. If a company's executives continuously sell shares before the quarterly earnings report, it can carry several messages. There may be entirely ordinary reasons behind it, such as financing larger expenses or taking advantage of another investment opportunity. However, from an investor's perspective, it never looks good, as it always raises the question, does management foresee weaker results, or are they reducing their exposure for other reasons? While on its own, it is not necessarily a negative signal, it is certainly thought-provoking, and market participants usually follow such transactions with increased attention. I have decided to wait for the earnings results, as I still believe in a potential price increase. Of course, this does not constitute financial advice. Based on the market's reaction following the earnings report, I will then decide how to proceed. In the video, I will include the image from the Open Insider website about the executive stock sales, and then I will continue with the usual news, the review of the current earnings reports, and finally the update on the status of my portfolio. Jerome Powell's Jackson Hole speech opened the door to a September rate cut as the labor market cools. The August flash PMI surprised to the upside, and housing market turnover picked up. The Dow closed the week at a record, yet retail earnings painted a mixed picture of the consumer. Powell reactions. Jerome Powell's Jackson Hole speech opened the door to a September rate cut as the labor market cools. The August flash PMI surprised to the upside, and housing market turnover picked up. The Dow closed the week at a record, yet retail earnings painted a mixed picture of the consumer. Powell reactions. The July FOMC minutes showed that policymakers favoring an early cut were in the minority, yet by week's end Powell signaled a data-dependent, cautiously dovish tilt. This immediately pushed yields lower and brought risk appetite to equities, typically within rate-sensitive baskets. FOMC minutes. FOMC minutes. Meanwhile, labor market signals were mixed. Initial jobless claims jumped to 235,000, the highest since June, reinforcing the slowdown narrative, while S&P Global's August preliminary manufacturing PMI jumped to 53.3, a 39-month high, indicating a short-term improvement in industrial activity. Claims, PMI. Claims, PMI. Note, interpretation. The combination of a weakening labor market plus strong PMI produced a market read of soft landing, faster cuts. This is interpretation, not a statement of fact. July existing home sales rose 2.0% to a 4.01 million annualized pace. Inventory is at a 5-year high, the median price is $422.4 thousand, plus 0.2% YY, and the 30-year mortgage average is 6.6%. This improved sentiment in stock baskets tied to home building and home furnishings, especially layered on top of the late-week yield decline. NR Writers' Summaries. NR Writers' Summaries. On the rail side, CSX-BNSF announced a new intermodal collaboration, strategically a long-term capacity plus service message, but the market had hoped for immediate MA. CSX fell tilde 3.6%, showing that index breadth was driven by rate-sensitive and housing-linked names, rather than by industrial M&A hopes. Among the leaders of the weekend rally were the home building/home improvement linked and rate cut beta names. Market color. Beijing emphasized consumption stimulus and housing market stabilization, while the LPR is expected to remain unchanged. The structurally weak property demand and household caution remain the main risks. U.S. channel PRC exposed supply chains and the volatility of China ADRs listed in the U.S., as well as the sensitivity of global commodity cycles and corporate margins. Despite Friday's rally, the week overall was mixed. S&P 500 plus 0.3%, Dow plus 1.5%, Nasdaq 0.6% small/mid-cap, Russell 2000 plus 3.3%. As yields fell, rate-sensitive cyclicals led, while megatech was mixed in a narrow range. As yields fell, rate-sensitive cyclicals led, while megatech was mixed in a narrow range. Despite Friday's rally, the week overall was mixed. S&P 500 plus 0.3%, Dow plus 1.5%, Nasdaq 0.6% small/mid-cap, Russell 2000 plus 3.3%. Consumer retail. Walmart posted strong traffic and raised its full-year outlook, but EPS missed. Tariff costs are pressuring margins, and the stock fell on the day of the report. This matters for the U.S. because Walmart is a consumer thermometer. Middle-income price sensitivity, private label mix, and a persistently tariff-laden environment are direct signals for margin trajectories across discount and FMCG chains. Home Depot described a normalization in demand for DIY small projects. U.S. comps plus 1.4%, 2025 guidance unchanged, aligning with a slight pickup in housing volumes. The message is stable base, slowly rising trend. Target beat on EPS while revenue slipped slightly. The stock came under pressure due to management headlines and a restrained full-year backdrop. Message: across the segment, promotion and mix management remain key. Margin trajectories will diverge sharply. Software, SaaS. Workday delivered approximately 12-13% revenue growth in Q2 but issued cautious forward commentary. The stock moved lower. This suggests that while HR ERP projects are proceeding, decision cycles remain sticky in public sector/edtech channels. Intuit reported a strong quarter and year, AI feature monetization, yet the FY 2026 guide cooled enthusiasm. The stock fell tilde 5%. Broader red, even quality growth can hit a pricing ceiling if guidance doesn't scale with expectations. Zoom beat in Q2 and raised, the stock strengthened. Message: there is demand for AI-based customer engagement and enterprise productivity stacks, but the top line remains mid-single digit. A stock selection story. Industrials logistics. The CSX-BNSF intermodal agreement is strategic, but the investor narrative is currently not a merger. Hence the short-term disappointment reaction. The rail consolidation theme lives on, remaining a potential catalyst for industrial index breadth. Cybersecurity. Earlier days, but weak relevant sentiment. Palo Alto Networks delivered double-digit growth, indicating that CIOs in the AI era are not touching core security budgets. In the US tech basket, this bolsters the defensive growth sub-thesis. Industrials logistics. The CSX-BNSF intermodal agreement is strategic, but the investor narrative is currently not a merger, hence the short-term disappointment reaction. The rail consolidation theme lives on, remaining a potential catalyst for industrial index breadth. Consumer retail, software SaaS, industrials logistics, cybersecurity. Overall, you saw a week of dovish-tinged normalization. Fed communications softened, the labor market cooled, while real economy indicators, PMI housing, did not roll over. The market priced this as falling yields broadening the advance beyond megatech, especially across the housing consumer chain. The main bottleneck now lies between policy risk, tariffs, and the valuation of the AI narrative. Powell, reactions, tariff front. Powell, reactions, tariff front. Question for you. If the Fed cuts in September, would you overweight the quality value basket, housing, industrial supply chain, stable cash flows, or the second line AI growth basket? Why? So let's see how the three strategies have evolved. Strategy 1. Lump sum. One-time investment. The first investor bought an S&P 500 ETF on January 2, 2025, investing the entire $15,000 at once. They've held the position ever since. No additions, no withdrawals. Current performance year-to-date, 95%. Strategy 2. Dollar cost averaging. Gradual investment. The second investor splits the $15,000 into 12 equal parts, investing $1,250 on the second trading day of each month into the same S&P 500 ETF. This approach helps smooth out volatility and reduces the risk of poor entry timing. Current performance year-to-date, 56%. The green line reflects this strategy, slightly outperforming the lump sum method so far. Strategy 3. My fictional portfolio. This portfolio is based on my own stock picks and investment decisions. It launched on March 19, 2025, with the full $15,000 invested in various individual stocks over multiple transactions. I've explained my choices in earlier videos. Current performance year-to-date, 84%. Note, these performance metrics exclude broker fees and taxes. They reflect only market-based price movements. Thank you for joining us on this economic journey with Test Portfolio XSX. If you enjoyed this weekly recap of the key events and our portfolio's performance, give it a like, subscribe, and join us again next week as we review the latest market moves and the progress of our investments. Disclaimer. This video does not constitute financial advice and does not recommend the purchase or sale of any financial instruments. I do not take responsibility for any potential inaccuracies or errors that may occur.